Well, I suspect, as we usually do, we might have a few people that kind of join us as we get rolling here, but I want to make sure to respect everybody's time. So we're going to go ahead and get rolling. Our presenter, Tim Lockwood, is here. We're very happy to have Tim with us. Tim and I and we have known each other for a long time, um, certainly around MoneyGuard, which is a kind of a stalwart product and an industry leading product, as I think most everybody knows on the long-term care side of the fence. It's a product that has gone through some changes, some positive changes here recently. As I think those of you who do business in New York, you know we're a little hamstrung when it comes to New York product. But as I think everybody knows, we do business in a lot of other states other than New York, and you have clients, even if you are in New York, in states other than New York. So the content is still relevant. Ran across Tim at the recent ILTCI meeting, and we put our heads together and say, hey, it's been a while since we put some Lincoln information out there and some MoneyGuard information. He reminded me of a couple of things that frankly had slipped my mind. I hope, Tim, you'll take a little bit of time at least and not only talk about the product solutions. I know you're going to cover a couple of case studies, but in particular, the one uniqueness I want you to spend a few minutes on, if you don't mind, is the fact that, oh, by the way, for those of you who are registered reps out there, Lincoln actually has a variable version of MoneyGuard that you may or may not remember. And there are some distinct advantages to that hopefully, Tim, you can touch on a little bit. So as he gets into his presentation, you'll get a lot more of that. From a housekeeping standpoint, yeah, we've got the lines muted. This isn't everybody's first rodeo by any means when it comes to Zooms or other online meetings. So we want to make sure we don't have any background noise, but that doesn't mean that Tim does not want your questions. So if you do have questions, you should have certainly the Q&A portion of your panel and or the chat portion of your panel. You can submit questions in either fashion. I'll be keeping my eyes open for those. And as Tim finishes up his prepared comments, we'll make sure we address any of those questions. We are also recording the session today, obviously for advisor use only, but as we do with our other presentations, we do have an archived training page at our website, as I think everybody knows. If you go to advisorsib.com, many of you are obviously logged in there on a regular basis, and you go to archive training under tools and resources, you can find information on that. This too will be added to that. Usually takes us a day or two to get that uploaded so you can view it. So with that in mind, Tim, once again, I see Bryce, you've joined us as well. Good to have you here as well. Thanks, both of you, for being here. With that, I'm going to go ahead and turn it over to you. The floor is yours. Great to see you again, Tim. Bryce, nice to see you with us as well. Tim, take it away. The floor is yours.
All right. Well, thank you so much, Bob. We certainly appreciate the partnership and the opportunity to re-engage as we've discussed. I was out of New York myself for a little while, but I am back and I'm excited to work with our partners there. And, I want to thank you, Bob, Melissa, and Jennifer for the partnership, along with the whole team up there just north of Albany. So, we've got a lot of exciting things to talk about here at Lincoln with the MoneyGuard team. As Bob mentioned, we are limited with no solutions in the state of New York, but we've made some significant enhancements outside of the state lines of New York across the country. And what I wanted to do today was kind of just start and kind of set the table for a little bit on the environment that we're dealing with. And this really presents an opportunity for you in the grand scheme of things. I then wanted to shift and kind of highlight the advantage of the MoneyGuard suite. And how that arguably should help you expand your reach when engaging your clients with long-term care solutions. So think younger clients, think clients who want to self-fund, who can self-fund, right? We kind of have evolved the MoneyGuard suite to really address a lot of the common objections that we face, that I've faced over the last, just short of 20 years in my role. And then we're going to finish up with some case studies with some funding ideas and love to address any of the Q&A. So to dive in, what you're seeing now is a deck of our market intel exchange. This is a quarterly newsletter, basically a chart book that Lincoln puts together every quarter. It's actually about closer to 80 pages. We're not going to go through 80 pages, but I selected a handful of slides that really focus on the inflation risk, the demographic risk, and really kind of wrapping up with LTC risk. This is a quarterly newsletter. This is something that you could subscribe to. We do update it quarterly. Now, a bulk of the slides are likely to stay the same, but as we approach midterms, presidential elections, there are topical slides and sections in there that are very relevant to potentially help set you up for a discussion. So when we look at this, you kind of look at the components of inflation, and it's no secret that everybody's really been feeling inflation, especially over the last 5 years or so. And this kind of takes a look and kind of outlines, all right, where has that inflation been? And yes, it does feel like inflation is trending downwards from where it was peaking a few years back. But the thing that we like to highlight here is, all right, well, how does the healthcare inflation really stack up to that headline inflation? And the reality is it's significantly more. We could really dive into nursing home and home healthcare and all of those details and really kind of unpack the fact that there's a challenge there. And we're going to see that in a slide or two. But I just really wanted to kind of show and outline, how these slides can help you kind of set the table. They're all very simple. On the right-hand side, you can kind of see the, hey, what does this chart show? Why does it matter? And yeah, while we might be feeling headline inflation, it's important for your clients as they're planning, especially planning for something that they need to be ahead of from a planning perspective, upwards to 15, 20, 25, 30 years. The impact of inflation is significant. And the level of uncertainty of where that goes is also a challenge. So when you think about the LTC cost and how they're outpacing headline inflation, it's pretty significant, right? Prices for home health care are accelerating, surging 21% since the start of 2024 alone, 5 times faster than overall inflation. And the reality too is when you think about, the pandemic, feels like it was just last year at this point, but people are doing whatever they can to really age in place and stay at home. Now, that historically has kind of been the mentality. That's how we want to set clients up for the future. But the reality for Lincoln, with 35 plus years in this market, we actually have a significant amount of claims paying assisted living facilities, right? So that is kind of, individuals' homes as they age. Only 10 to 12% are in nursing homes as far as our claims are concerned. And post-pandemic, that nursing home stay claim percentage was still, kind of stayed in that range of 10 to 20%. But the reality is the rest of that 85, 90% is split both ways. So costs are rising. Your clients likely underestimate the actual cost of care today, let alone the impacts of inflation. Now, the reality as well is when we think about what we've dealt with over the past few years, this is likely not going to get any better anytime soon because the demand is only going to increase while, the worker shortfall is a real thing, right? So really some nice client-friendly slides to help you kind of tee up the conversation, pick and choose what you like, what kind of goes on along with your narrative. But, for the long-term care workforce specifically, demand is expected to rise even faster by 33%. So when you think about, what we're looking at, people who have plans and planned in advance are going to have more control over the quality of their care and the selection of their care. So, and then when you look at the demand side, we know the supply side is kind of shrinking to some degree or not growing as fast as demand is. The demand is not going anywhere, right? You have the whole, baby boomer generation, aging, and, the first baby boomers turns 80 years old this year. I mean, our average claim age is 83 years old. So, the boomers are right knocking on the door of what we see as an average claim age. Now, that doesn't mean that we don't have claims at a younger age, because that is very much real. But the demographics and the pressure that's going to put on, the available supply of workers, healthcare workers, long-term healthcare workers, it creates a challenge. So, a huge opportunity for us to engage. And when you think about this, right, obviously, as I'm walking you through, this short selection of slides here, you're thinking, all right, these baby boomers, we've got to talk to them. But what if I told you that that's not necessarily who I'm solely focused on? Because as you look at this and you look at kind of the 2030, 2035, and the impact to that, right? 1 out of 5 Americans are going to be over 65 in 2030. 1 out of 3 age 65 has some form of dementia, right? Who I believe is the bigger opportunity here to some degree is the baby boomers and this older generation's adult children. So if you're not engaging with the next generation, you might be missing out on a huge opportunity to plan in advance when the optionality is at its greatest. So something that I really wanted to kind of highlight for you, we talk a lot about monetizing good health. A longer lifespan doesn't necessarily mean that you're going to be healthy that entire time. We've enlisted a featured speaker a few years back and a gerontologist. He quoted the gap between lifespan and health span as a 12-year gap. That means that, the years you're healthy, there's a gap of 12 years of when you have a good health versus when you pass away. So it is, significant, and there is a significant opportunity. And as these older Americans age and need care, that just sets up the need for the adult children who might be looking at you and thinking, how do I plan for this now when I'm in my highest income earning years? Or how do I plan this now after I just got mom and dad's or grandma, grandpa's, inheritance? Really a massive opportunity when we think about generational wealth planning. And obviously, a lot of people focus on the stats. I'm not really a big stat person because everybody's experience is very, individualized and personal, right? This is really an emotional sale. I think the key is most of your clients, I'd argue more than half of them, upwards to 3/4 of them, you'll have an experience with a loved one needing care. How long that care is going to last, it's going to come down to what that diagnosis is, how healthy physically they were, and kind of how early they began needing care. But it almost doesn't matter how long you need care. I mean, $100,000 to $200,000 a year is, a significant amount of cash flow that would be needed, as we progress through retirement and work through our financial comprehensive plan. So that's really the setup. You can, subscribe to this. These slides are client friendly. They update quarterly. Really a great resource for you. So, as we talk about the MoneyGuard solutions, we have really revamped the MoneyGuard shelf, if you will, since I've been in front of this group and partnering with Bob and his broader team. But we have solutions to offer Americans from ages 30 all the way up to age 80. And that's going to encompass both our fixed and our variable solution. And what we're seeing a significant trend towards are these younger clients. So just to kind of highlight a couple of things. One, our average issue age is right in that mid to upper 50s. So we are sub 60 years old as far as an average issue age. Our average claim age, as I may have referenced earlier, 83 years old. We can still issue up to age 80. Where we are going to be most competitive is going to be in this range of 50 to 70. If you're a registered rep, I would dial that down about 5 to 10 years because we're seeing a lot of business for folks in their 40s on that variable chassis. And we're actually seeing some, generational planning through gifting strategies with the adult children of our wealthier clients. So as you think about this, the traditional client that I suspect many of you may have looked at, for these types of solutions were these cash strong clients. And these cash strong clients arguably were retirees. They're between 50 and 75 years old. And they most likely kind of leaned into the right side of this quadrant flyer here, which is still something that we can address, right? We can still write policies all the way up to age 80 for those retirees. The challenge is going to be is where's the funding coming from? And the leverage is going to be lesser than what it would be if they planned, a decade or two younger. A couple things we'll come back to as we look at this. One, 1035s. Lincoln can use $1035 and split them between solutions. The other thing that we've been seeing a tremendous amount of activity around, especially for these pre-retirees or more recent retirees, is these inherited IRAs. So because of the Secure Act, if an adult child inherited an IRA from mom or dad, they've got to distribute those dollars within 10 years. Uncle Sam wants that tax revenue. So if I, inherit, $500,000 from dad when he passes away, potentially after needing care, that $500,000, I got to distribute that $50,000 a year without factoring in any growth to that. So let's call that about $37,500 of net after-tax dollars that I can work with to parlay into a planning solution. These pre-retirees are kind of a perfect storm for a planning opportunity, right? They're in the perfect age range between 50 and 70. They've got newfound cash flow that they have to distribute from these inherited IRAs, forced distributions. And then lastly, what are the chances that mom or dad, grandma or grandpa, who they inherited this from, needed some sort of long-term care? So you have that emotional motivator there regarding a past experience with long-term care. So let's kind of highlight kind of how some of these solutions come into play, and we can come back to some of these profiles and close up here. But right now, let's just kind of talk about some of the basics, because in all states outside of New York and California, we have our newest generation MoneyGuard Fixed Advantage 2025. This has been available for just about a year in all the other 48 states. And your story here is pretty simple. I'm going to jump to the ledger and then come back to this. But, this is an average case for us. A 58-year-old female in New Jersey. She's married, so she gets a couple's discount. Our underwriting is pass-fail. It's streamlined. We can offer a couple's discount or standard underwriting. It's either you're passing and getting those benefits or you're not, or maybe you're postponed. But for trading purposes, I just looked at a flat amount. We can fund these over 10 years, a single premium, anywhere in between. Oh, by the way, we can drop in a lump sum and fund on a flexible premium schedule above and beyond that lump sum. But really, to keep things simple here, I repositioned $100,000 over this 10-year period of time. And if I jump to my average claim age, again, this solution, all values and benefits shown are guaranteed. This was targeting those idle dollars, those lazy assets, that sideline money, to reposition it into something fully guaranteed, with a known outcome, right? So when we look at age 83 to 85, you're looking at your same very simple story of leverage, legacy, and liquidity. I call it the 3 L's of asset-based long-term care. You got your tax-efficient leverage in the event you need care. In this case, it's close to 9 to 1 on the dollar. If you never need care, we got to return a capital and a legacy benefit, and then you've got to return a premium. Oh, by the way, we do still have 100% ROP. It's less than 5%, if not less than 3 to 4% of our current business mix, but that is an option. A lot of folks out there do lean into the internal rate of return as a way to position this, because the argument is where can you get that type of return guaranteed and guaranteed tax-free? So to me, the key is, all right, where are you going to come up with 150 grand a year? Well, here you'd only have to come up with, call it 15,000 of that 150, if that's the number. So how do you come up with that cash flow? We're always going to put an inflation option on here. And in this case, it's a 3% compounding inflation. So that is really the simple story of leverage, legacy, and liquidity. Let's transition now and highlight some of the key updates and enhancements and really what separates Lincoln in today's market. One, we are a carrier now that is offering benefit choice at the point of claim. So your clients are not locked in at the point of sale to say it's either reimbursement or it's indemnity. You have, in this scenario, we have access to close to $880,000 in a bucket of money. You only see one number there. At the point of claim, we can choose whether we want to distribute that bucket as an indemnity style benefit or a reimbursable style benefit. You've got access to the full 879 regardless of that choice. Now, the beauty of this is your clients are not making the choice on the indemnity or reimbursement until they're at claim time. So if they chose reimbursement, that's the way to maximize the distribution of that bucket. And they're going to get $11,336 on a monthly basis. Oh, by the way, we can set up direct billing with that choice. So that's a care provider billing Lincoln directly and Lincoln paying that care provider directly. Based on a diagnosis and needs for care, that might be an appealing option. Or we can look at our indemnity choice, which is 80% of that 11,336. Now, when you choose the indemnity option, you're not forfeiting the 20%. That's just rolling downstream to your overall bucket of money. So your 879 is just going to last longer than your designed 6 years. And oh, by the way, if you really like, the indemnity side of this choice, you could actually design this as a 5-year bucket. And if you choose indemnity, you got a 6-year indemnity style distribution bucket. So this is relatively new in this benefit choice. Again, we're always going to put inflation on the vast majority of these cases. And this is one of the big differentiators that Lincoln outlines. Now, that choice for our policyholders is not limited to the individual that is the insured for the LTC. We also provide a benefit to the beneficiary at death of a companion case. So if this female's husband predeceases her, she has the ability to transfer some or all of his death benefit into her existing policy because she's the beneficiary and she has her own policy with our benefit transfer rider. So this is almost like a joint solution on a multi-contract design, first to die design that can be customized, that links multiple policies together with transferable benefits at the first to die. And then lastly, nothing really new here for us, but the 0-day elimination period, it sets us apart. We're the only carrier really with a 0-day on all covered services. Day one, you're not having to really, pre-fund that 90-day period, which is a liquidity risk, by the way. In 30 years, how much does a 90-day, elimination period cost out of pocket? Something to consider. Do we have that liquidity available? So these are really our 3 big differentiators: our 0-day wait, our point of claim choice, and our benefit transfer rider. Now, last year in April, there were 2 other additional things on top of this benefit choice that we did launch. One is the split premium for the long-term care. So for any of you that are engaging in, with business owners and doing that type of planning, using business dollars to potentially fund life insurance or long-term care, our premium split and the ratio approach that we take, which is unique, has us capping the LTC premium at about 85% of the premium. So if you have a C Corp funding this, that's a top line deduction of close to 85% of the premium. We can generally design these to max out that ratio, but that ratio is generally going to land somewhere between 50 and 80%. So this is generally new for us as well. And you're going to see that LTC premium split on this summary page here. Now, the last thing that I think is important to highlight is over the years, hey, Tim, can we add to this? Can we increase our benefits down the line? Well, it's a little bit of a tricky answer because there wasn't a way to increase benefits. You had to actually apply for a new policy and layer a secondary policy on top of this. Now, with our new Advantage series, we can actually do a policy increase and increase the benefits of in-force contracts. So now the answer to the question of, hey, can you increase the benefits on this policy? Yes, you can. If you're insurable, you can go through a policy change and increase the face amount after year one, up to age 80, and a minimum of a $25,000 face amount increase. That would increase your target, which would be a commissionable sale, essentially. And that's something that just adds flexibility and option. So if you're planning and looking at some solutions, well, why don't you start off with maybe a little bit of a dial back plan? And when you run into that money you expect to run into in 5 to 10 years, maybe we can relook at increasing your benefits on your existing contract. So a lot of flexibility and the theme of optionality here. Now, if we're looking at kind of, targeting a younger demographic, one kind of case study I shared with Bob and his team a little while ago is, well, what if we got a 44-year-old female, right, who's maybe part of a family business or could be the recipient of a gift? We just looked at 15 grand a year over roughly 5 years here, total of 75 grand. And in this scenario, we did design a 5-year minimum duration. And when you look at the benefits and the leverage of this, this is extremely powerful because number one, we're looking at the 5% compounding inflation option here. And this drives that 75 grand to grow to close to $1.2 million in a pool and upwards to $17,000, $18,000 a month in a benefit. Now, a couple of things that we've done here just to kind of highlight and look at is, one, you've got the benefit transfer rider in this scenario. So if she's the beneficiary of dad's policy and dad predeceases her when she's 60, she's got the ability as the adult daughter who has a policy and is a beneficiary to take some or all of that death benefit and transfer it into her contract. So a powerful story here that when you look at that 50,000 and the before and after, you're taking a $1.173 million pool available over 5 years. And now you're, making that a $1.527 million pool at age 85. So you're basically getting an extra 350 grand off of a $50,000 transfer that doesn't entail any underwriting at the time of the transfer. So obviously at 60, we'd like to think that we're still healthy, but this just provides some optionality for these clients. And I think this is a nice feature and highlight to show the generational planning opportunity here. Now, as Bob mentioned, we rolled out a variable solution. So what if the argument is, hey, I'm a little too young for this. Why don't we revisit this when I get older and get closer to retirement? Well, what if we could leverage, some of the similar tax-friendly treatment that a VUL, is fortunate to take advantage of, right? The U.S. tax code really allows for certain accounts and strategies to grow on a tax deferred basis. So when you think about, 401ks, IRAs, Roths, HSAs, right? HSAs are great, but they're very, very limited. High income earners can't fund Roths, right? Yeah, they can backdoor, but essentially you're not dollar cost averaging into a Roth if you're a high income earner. So what if we could deliver a tax efficient strategy for long-term care funding that is tax deferred as it grows, is tax free as it's distributed, and also has a tax free death benefit at the time of death if never tapped into? So what this does is this highlights our MoneyGuard market advantage strategy and really stacks this strategy up against a self-funding strategy. So what I found since we launched this in 2021 is this solution really addresses 3 key objections that we've heard with the fixed solution. One is my clients can self-insure. They can self-fund. We will out-earn any long-term care risk. We kind of take that off the table here, and I'll walk you through that. Number 2, I like the strategy here, Bob, but what if I don't need care? I don't really see a strong IRR on the life insurance component, right? We kind of address that as well. And then, as I referenced earlier, Well, either you as the agent said, I'm only talking to clients 60 and older, maybe 55 and older. Hopefully we're at the point where it's 50 and older, but we're too young to really address this. You can dollar cost average into this. Technically, we can fund this up to age 75 or year 15. Generally wouldn't fund it over that long a period, but let's take a look at this design because this is a 55-year-old funding $15,000 a year over a 10-year period of time, and then looking back on a 24-year period of historical returns with the S&P index, the S&P 500 index at an 80% allocation. That's stacking up mutual funds, and that's stacking up insurance variable subaccounts. And oh, by the way, the 80% with the S&P index is the State Street mutual fund versus the State Street variable subaccount. The other 20% is a bond position. We've got over 50 variable subaccounts to choose from and build that allocation, but this is really here to keep this simple. We're factoring advisory fees, tax exposure, all that fun stuff into this comparison. So if we look at this, and if we solely look at accumulation, the investment strategy is going to win out from solely an accumulation and an available asset standpoint. You're going to win. There are some fees that are dragging the cash value down slightly, but obviously you're getting something for those charges. And oh, by the way, your available asset on our insurance strategy is likely double, if not triple, the amount that it is on most of our fixed solutions. So you're going to get a small piece of leverage on the life insurance component on the fixed strategy. Here, you're going to see kind of how this comes into play, right? Because you could take a policy loan from that 509. That's your balance for surrender as far as an exit strategy. It's part of your overall portfolio as a position, right? But what if care is never needed? So what if I go back to that one objection of, hey, this leverage on the long-term care looks great, but what if I don't need any care? I'm not a big fan of the IRR. Well, now let's see the difference, because now with the insurance strategy, you're in the insurance corridor and that cash value growth is pushing up that death benefit. And that's essentially uncapped based on underlying market performance. So would you rather have the 738 or the 594? Because now, if care is not needed, you got the same value as your available asset in your investment strategy. But really where this comes down to is, and why we're looking at this primarily, first and foremost, is for that long-term care. And if in the event we need care, we're going to deliver a 4-to-1 multiplier on any tax-deferred accumulated growth. So we're going to give you a 4-to-1 multiplier on this 509, which is over $2 million in long-term care benefits. That's completely tax-free. Yes, you can choose indemnity or reimbursement. That's about a $30,000 a month payout on a reimbursable style benefit and about $24,000 a month on an indemnity style payout. And that's a choice of the policyholder at the time of claim. And again, it's an uncapped strategy. Over here, you're still dealing with the same $600,000. So to me, it's pretty clear which option we would go with, right? Why not dollar cost average into something that can go and grow on a tax deferred basis? Why defer a decision on long-term care planning when you can do it in advance, when you have more options and a longer time horizon for either compounding inflation to grow or your market linked performance to grow? So when we look at our broker dealers, for those of you in a broker dealer, this is over 53% of our business as of last year. And it's taken very well in the broker dealer space, where we really believe in the market over the long run. And here's the matching illustration to this. So you're going to have access to BlackRock, Fidelity, Vanguard, a lot of the funds that your clients may be very familiar with. You also, as a registered rep, may be working with the wholesalers of these fund managers. So definitely some optionality there with the allocation. And oh, by the way, you do have downside protection that locks in. But what I wanted to highlight here is really this very similar strategy of, leverage, legacy, and liquidity. Now, this is a 6.5% rate of return on the same exact case that we just reviewed. That looked at historical performance. This is looking at a 6.5% gross rate of return. The beauty of these illustration designs is we're going to give you not only an illustrated rate of return, we're going to give you a varied rates of return here in a snapshot, but we're also going to deliver on that historical performance report as well. So, if we get closer to 8.5%, you can see, the upside that is not capped. And you might be thinking, all right, well, it's great, it's uncapped, but is there a floor? Well, there is a floor on this. So let me go to the historical report, tie all this together, and then we can open up for any Q&A. So here's your funding pattern, and we've got some very baseline guarantees from day one. These baseline guarantees are going to guarantee your premium and guarantee this contract will never lapse as long as we fund it as planned. So that is there, and you got these baseline guarantees. But as we grow the underlying values, right, this is what we were looking at, this 509, right? And then your $2 million, your 30,000 a month, that's what we were just reviewing. Here's your leverage, legacy, and liquidity story. Now, every year on the year anniversary date, we look at what that cash accumulation value is. In this case, 509, the prior year, and we lock in downside protection. So this protected value column is a safety net that ratchets upwards and never goes down. It's a one-way ratchet. So if the market totally blew up in our later stages of this contract, we've got a safety net that locks in a guaranteed pool. In this scenario, $1.273 million. So some nice features that have really been pulled from, annuity build outs and product features as far as income benefits. And obviously, this is actually pulling in 2025's performance. And, we saw significant growth in 2025, right? That's going to push up your legacy benefit and it's going to push up your overall pool here. So this is a solution that really is going to speak to your clients who believe in the market, who have the desire to participate in the market, have a longer time horizon, or are of a higher net worth. So, Bob, I certainly appreciate the time here. When you look at that variable contract, we'd really ask you to kind of focus in on your high net worth clients because, they wouldn't lose sleep by positioning 20, 30, 40,000 a year over 5 to 10 years. They might just dump a lump sum into something like this. We had a $70 million couple down in Texas plug in $50,000 a year for each of them over a 10-year period of time. They were 60 and 61. We can issue that up to age 70, but high net worth clients, high income earners, individuals that understand the market dynamics and the fact that if you have time in the market, specifically a decade or more, that the real question that we want to be asking is, does market performance outpace a 3% inflation option? Or are we young enough to be able to get a 5% guaranteed inflation protection option as a design feature if we're young enough, at the time we're really looking to pull the trigger here? So we can fund these contracts on a flexible premium design. It's not always about moving and repositioning one lump sum. I feel a segment of the market still sees that. So this really opens the door for you to have more meaningful conversations, with clients that could potentially fund this and potentially clients that you might not think would be interested in this, but they might be dealing with mom and dad at home. And have we uncovered that story of what might be the motivator for them to do some planning? So, Bob, I'd love to, first off, thank you and your team, but also see if there's any questions in the queue.
Thanks, Tim. Appreciate it. Okay, gang, this is your opportunity to ask Tim any questions you may have. I don't see any out there right now, but I'll add a couple of comments. And I was making some notes as you were going through, Tim. You know, it's funny, some stuff we hear and we forget and we stop using it. And then you remind me of things. And then there's some new things that you shared that I was like, I dig that. Um, Leverage legacy liquidity. What a great theme to use in this type of planning scenario. So I like the fact that you shared that. I can see the t-shirts being made up now, the 3Ls or something. I don't know, but I'll let you look into that. Um, the other thing that I wanted to mention, and it made me think as Tim was going through some of the resources available at the very beginning, and I agree, you know, statistics are never going to win the day necessarily, but they do point out the risk, right? So that's obviously something you want to be dealing with. But Tim also shared, you know, the risk from a financial standpoint and some of the other public programs and the challenges that they have. I did a presentation at an elder law forum last week for a law firm that does that here in our area, as it is. It's the 31st annual that many of you know Lou Piero here in our area, Piero, Connor, and Strauss. They do this elder law forum. They got 300 or 400 people in the room and another 700 online. And they were talking a lot this year in particular about what's going on with Medicaid, particularly in the state of New York, but everywhere it's happening. And a lot of the discussion talked about preference. Well, if you have clients that are looking at this, and to use Tim's words, they are either consciously or subconsciously self-insuring or self-funding, well, that might not be the best way to approach this, but it certainly does point to anybody who might be thinking about whatever benefits might be available in the public realm. I think that might be a fool's bargain. I think any planning that you're doing with your clients that is geared toward the personal responsibility and the private financing end of it is going to put them at a higher rung on the preference ladder than other people that might otherwise not do that. Thanks for that, Tim. So I think, you know, maybe the group that we're talking to, particularly in this instance with this type of product that Tim talked about today, that particular client makeup, okay, maybe they're not planning to go on Medicaid, but it's still a discussion that goes on with everybody. There's still that perception out there that, hey, even if I'm upper middle class, I'm still going to have Medicaid available to me. I'm not sure that that's going to be the case. I mean, we know we're in trouble now. You take 5, 10, 20, 30 years from now, who knows what Medicaid's going to look like New York or elsewhere. So thanks for that. The other one, I have a personal preference, Tim. You showed that IRR column. I love that column. When you're showing the internal rate of return and you're equating that to, okay, when you go on claim, because I think there's a cost versus value part of our conversations on the long-term care side. So to be able to say, look, win, lose, or draw, so to speak, you're going to benefit from this type of a policy. And to be able to equate an internal rate of return to the long-term care benefit on an after-tax basis, because you're right, the benefits are going to be income tax-free. That means if you wanted to back into that at, let's say, 8%, I know some of the years were higher than that, but at an 8% internal rate of return, you factor in a tax bracket for a reasonable individual. You back in I don't know, a 30% tax bracket. What do I have to earn to replicate that guaranteed internal rate of return I'm going to get? Can I really self-insure? There you go. Am I really going to be able to self-insure or self-fund that on a guaranteed basis and match that internal rate of return of 7%, 8%, whatever the number might be? I think that's a fool's bargain as well. So I think that's valuable to show clients and prospects when you're demonstrating the power of these products as well. What else? Thanks also, Tim, for sharing, because this was a development that has changed over time, and it's been a while since we revisited it. The fact that they can choose between reimbursement and indemnity. One of the other things we talked about the Elder Law Forum last week, especially in more rural areas, whether it's here in our home state of New York or elsewhere, home care is getting a little bit tougher to get from a home care agency. So if there's a distance between your loved one needing care and that health care or that home care agency that might be out there, such that it presents a challenge, to be able to use the indemnity benefit to get a little creative in terms of how that benefit gets paid out can be very advantageous. So thanks for reminding not only me, but everybody else about that. I still don't see any questions out there. Hopefully I'm not missing anything here, gang. Maybe you just did
Well,
such.
I would just jump in, Bob,
Yeah.
with our streamlined underwriting process.
Okay.
We really, changed the game for these types of solutions back in 2007, 2006, when we streamlined the process, which meant no APS records, an interview, and a pass fail decision within just a few days. That has kind of stayed intact, but we've really looked to improve on that. You might say, all right, how can you improve on that? Well, nowadays, a good portion, if not the majority of our interviews are done online. And surprisingly, they're done at about 10:15 at night, and they're taking clients about 20 to 30 minutes to do online. If we're
Mm,
60 and under, another big win is we are eligible for a real-time approval. So that's underwriting automation coming into play where you could go in there, and I have a customer, a brokerage manager who's about 51 years old, and he got approved in 13 minutes.
mm.
13 minutes. So
Yep.
these things can really turn around very quickly. We are developing a digital pre-qualification tool. We're always trying to find ways to meet the field where they want to be met regarding field underwriting. Why? We historically have approved 80% of our business. The challenge has been is the 20% that does not get through would be picked up by our first 2 pages of our pre-qualification tool. That's steroid
Mm,
injections, that's physical therapy, that's pending surgeries coming up. Those are the more common ones. Pain medication, a handicap parking placard. So we could really, if we use the pre-qualification tools that we deliver on a consistent basis, you could argue that the effective approval rate is closer to 85, 87%.
sure.
So we want to approve business, and we have kind of built in some flexibility to look at records on a very limited exception-based scale as well.
Yeah, thanks for pointing that out, Tim. Look, I'm a firm believer in process as the new product, quite frankly. As wonderful as the Lincoln products are, look, I would tell everybody that we still have one glaring problem in our industry, and that is we're not talking about long-term care planning enough, just in general. And then when you kind of whittle that down and say, okay, let's help get the clients through the process as seamlessly as we can, that becomes very important. So, not that the product is unimportant, don't take my comment the wrong way. Product is important, but process really, especially nowadays, and we've seen improvements as an industry, especially since, the height of COVID. But hey, we can all get better, and it sounds like you guys are on the right track. So thanks for sharing that.
Absolutely.
Hey, no other questions online, guys. You did such a good job, Tim, explaining everything that you've either baffled everybody or you've just given them so much information they're still writing. So I'm going to let you have the last word before we go ahead and finish things up and let everybody get started with their early holiday weekend. So thanks again, both to you and Bryce, for being here. Tim, what last words do you have before we wrap up?
Yeah, I would just say thank you for the time today. Thank you for dialing in and hearing what Lincoln has. My ask would be engage with your clients. Do not discriminate based on age. Anybody between 30 and 80, the reality is who is on your calendar. What I would ask is if you have somebody on the calendar between 45 and 70, run an illustration, have Bob's team run a design for you, and we'll hop on a Teams meeting and walk you through the key components, the key design options, and key things that we feel our agents and advisors who are successful really like to point out. So everybody have a great holiday weekend, and again, thank you for your time today.
You bet. Thanks, Tim. Thanks, Bryce. Hey, thanks everybody for being here. Enjoy your long weekend as we start to bump up against it tomorrow, and look forward to catching up with everybody soon, okay? All right. Thanks again, guys. Appreciate it. Take care.
Bye bye.
Thanks.